This is Will McCauley with SeaIntellect. I'm going to discuss our views on the natural gas market for this week. At SeaIntellect, we remain bullish for the July 2019 natural gas contract. We actually reinitiated our long position earlier this week after being flat for a few weeks on a stopped loss of a retracement in prices earlier in the month of February. Year to date, we are up 2% on an unlevered basis, and that compares to 2018 where we were up 43% on an unlevered basis. Specifically, we're looking for the July 2019 contract to clear the board somewhere between $3.05 and $3.25 per MMBTU. That compares to the market currently trading $2.89, $2.90. So still some decent upside from where we are today. Another thing that we forecast each week at SeaIntellect is natural gas storage. For the week ended last Friday, the actual storage withdrawal in the United States was minus 166 BCF. That compares to our forecast of minus 168 BCF, and then the market's expectation of minus 174. So our modeling was very on top of the actual withdrawal for the week. I want to talk about three main factors that we think are impacting the natural gas market in both the near term and the longer term. The first is temperatures. We kind of have a double situation here where we have a colder than normal forecast for the next couple of weeks of March, basically through the end of the withdrawal season. And then the early indications for summer forecasts are above average normal. So we're expecting higher power burn this summer based on the forecasts we're seeing today. Specifically, we're expecting withdrawal season storage to end somewhere between 850 BCF and 1,360 BCF. That compares to the 5-year average of 1,680 BCF. So still a significant deficit, but much less of a deficit than we saw earlier during the withdrawal season. The second thing that we find important is the coal to natural gas power generation switching. We see that happening around $3.25 per MMBTU. As gas falls and stays below that level, you will see coal generation shut down, or while natural gas generation will pick up the slack as it's more economic to burn natural gas than it is coal. We've seen that happening for about 4 weeks now after winter gas prices pulled back as storage normalized. We think that $3.25 is kind of a fundamental ceiling on natural gas in the near term. That's why that's the top end of our forecast for the July contract. The last factor that we want to talk about is total U.S. supply, both associated gas and gas from gas-directed rigs and wells. We look at a rolling 4-week average. For the last 6 months or so, we've seen 3 major trends. The first was a downtrend followed by a short uptrend. We're now on a downtrend again. So the first downtrend went from the end of September through early January, and we were seeing natural gas total supply up 49 BCF year on year at the beginning of that period, declining to up 27 BCF year on year. So still growth, but less so. The second period was a strong growth in year on year supply, basically for the month of January, that went from the 27 BCF per week year on year that I discussed previously, all the way up to 78 BCF per week year on year. So a drastic uptick in supply earlier this year. And now we've seen a downtrend again, going from that 78 BCF to a 64 BCF, again, year on year change in supply. So still strong supply, but we think given the LNG exports, Mexico exports, and strong potential summer power demand, that the growth needs to be stronger than where it is today to maintain prices at the current level. For our full view on natural gas, crude, and power markets, visit our fundamentals report at SeaIntellect.com.